Our next guest says the Fed has lost sight of its overall strategy, has instead turned into a play-by-play commentator. Still, he expects the Fed to cut rates now, he says, twice this year. For more on that and his take on the Treasury Secretary, sitting at the same chair that Joe Kernan sits, but always this time, I think, with a different opinion. Mohamed El-Erian is here, Chief Economic Advisor at Allianz and President of Queen's College at Cambridge University. Play-by-play commentator, that's kind of harsh. You're not usually like that.
Well, it's because of the amount of volatility they've put into the marketplace. The Fed should be the strategic anchor to this market and leave the play-to-play commentary to others. What we found is with 19 Fed officials speaking, they've become a play-by-play commentator. And we saw last week what that does to market. It imposes an unnecessary amount of volatility onto it.
It's because we feel like we're at an inflection point, right? This is, it's one thing for everybody to be talking when we kind of know the direction of things. But I think everybody's looking for any cue anywhere to try and figure out what the Fed will do next, because it's just unclear. Yeah,
and there's a couple of things going on. One, I think the whole notion of transparency is being implemented in the wrong way. I'm all for transparency, but it has to be in a way that fulfills the objectives of
transparency, but nobody's allowed to talk?
No, just talk, but talk with a longer-term view. Don't talk on every single change. And the other thing is this Fed, unfortunately, has become excessively data-dependent. And when you become excessively data-dependent, you start being swung around by the data. You know, there's an old image that...
But shouldn't you be excessively dependent on the data? Shouldn't that be the whole game?
No, high-frequency data tends to be incredibly noisy. So if you're excessively data-dependent, the image you have is of a roller coaster. The markets, the data, the high-frequency data on a roller coaster. And the Fed has two choices, either to get onto the roller coaster or stay on the side and try to provide the anchor.
So your argument was that they should do nothing right now and kind of wait it out and see where the data heads? Or
No. If you take a strategic view of the economy, they should definitely cut twice. If you are overly data-dependent, you're going to be taken to a place where you may end up not cutting. And that's going to be the difference. And if you don't cut, that may unnecessarily undermine U.S. economic exceptionalism.
Let me read you, Mohamed. This is Jamie Dimon's letter, came out this morning. And he says, many economic indicators today continue to be good and possibly improving, including inflation. When looking ahead to tomorrow, conditions that will affect the future should be considered. For example, there seems to be a large number of persistent inflationary pressures which may likely continue. All of the following factors appear to be inflationary: ongoing fiscal spending, remilitarization of the world, restructuring of global trade, capital needs in the new green economy, and possibly higher energy costs in the future, even though there currently is the oversupply of gas and plentiful spare capacity of oil due to the lack of needing investment in the energy infrastructure. What do you make of that?
I think Jamie Dimon is absolutely right. I think that the last mile, so-called, in the inflation battle is going to prove much more difficult than most market participants expect because of the reasons he cited. We live now in a world where the supply side is a problem, not the demand side. The big debate is, does that mean the Fed should pursue a 2% inflation target regardless of the change in the global macro paradigm? Or, in my view, it should be tolerating slightly above 2% in order not to sacrifice the economy.
So if you do no cuts, right? What happens to the economy? And by the way, there's the economy, but then there's the impact that all of this government debt that we have is going to ultimately have on the economy.
Correct. There's a huge fiscal issue that we don't talk about enough. There's a huge structural reform issue that we don't talk about enough. We are too focused on the Fed and on inflation.
But no, what I'm saying is, should the Fed be even thinking about the fiscal issue, which is to say that the cost of our debt is going to become a problem very soon if it isn't already?
But if they start thinking about that, then they're basically enabling the fiscal authorities to continue doing that if they're cutting rates to make sure that we don't get out of hand with those things.
Correct. And they shouldn't be thinking about it. Whether they do or not, I don't know, but they shouldn't be thinking about it. What they should be thinking about is their dual mandate and what is the right inflation target. Or if you want to be sort of more diplomatic, when do you want to get to 2%? Do we need to get to 2% quickly? Or can we get there over the medium term? And if you notice, a very important descriptor has come into. Whenever they talk about 2%, they say the longer-term objective of
Larry Summers has been pretty critical, too. He is saying they shouldn't do anything right now because we can't even decide on what a neutral rate is. I just heard him saying that if you don't know what the neutral rate is, that's like driving a car and not knowing what your speedometer says. Like you just don't know how fast this economy should be running at this point, and that's a reason for doing nothing.
Yeah, Larry reacted quite violently to the comments of Chair Powell last week, when Chair Powell said, we don't know where our start is. And Larry's point, which is correct, is, well, you better have some view as to where our start is. Again, that is an illustration of a Fed that's too data dependent, that is not looking at the strategic element. Of course, you have to have a view of where our start is. That's so critical to your path.